Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Michael Kitces on the secrets to accelerating growth and maximizing efficiency. It's a conversation with the industry thought leader from Kitces.com. I'm Mindy Diamond, and this is the Diamond Podcast for financial advisors. At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients, or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more. Few people in the wealth management industry have a name that resonates like Michael Kitces. No doubt, many know him from his website, Kitces.com, his industry-leading financial advisor success podcast, research reports, and his otherwise wide media presence. Aside from his resounding voice, few may not realize that Michael's advice and narratives come from deep-rooted experience. Michael is the head of planning strategy at Buckingham Wealth Partners, an independent RIA with more than $50 billion of assets under management. And he's also a co-founder of XY Planning Network, AdvicePay, New Planner Recruiting, and several other industry-related firms. Through this all, Michael somehow finds the time to be a gracious guest, willing to share his time and knowledge with the rest of us. And in the case of this series, it's the fourth time that Michael has joined us. So be sure to check out the other episodes, links to which you'll find on this episode's page. Today, we tackle a few key business topics that many advisors frequently seek advice on. That is growth and productivity, and how the two go hand in hand when building a successful wealth management business. Michael has plenty of actionable advice and tips to share. So let's get to it. It's always such a pleasure to share the mic with you, and can't wait to hear what you have to say today.
Good to be here. I appreciate the opportunity, Mindy.
You bet. So look, you probably need little introduction to most. You've been on this podcast as a guest 3 times in the past 7 years. We always hear about the Kitces acolytes. And I guess as part of your answer, tell us, what is it that you think the number one thing they get from you that keeps them tuned in all these years? And just give us who you are and what it is you do for those that may not be familiar.
Sure. So I guess a little bit of background. I wear a couple of different hats. Still, I'm a registered IR head of planning strategy for what was Buckingham Wealth, now Focus Partners Wealth. I'm also co-founder for a number of different companies that serve the industry: XY Planning Network, AdvicePay, FP Pathfinder, and New Planner Recruiting. But most folks know us for the work we do at Kitces.com, where we're providing education, professional development back to the advisor community on both the more technical planning topics and the practice management side, which includes a division of the company called Kitces Research, where we do a series of 4 rotating industry studies on advisor technology, advisor marketing, advisor well-being, and advisor productivity, which we just released recently, and digging deep into just everything from like how advisors do planning software they're using, how they're pricing, way they structure their service teams, and so forth. And we get a lot of fans to the platform. I think that, just as I view it, we talk to a slightly different segment of the industry. It's a group that I've taken to calling the advisors. So like advice the word, the verb, ERS on the end. Advisors, not advisors, which to me is just that portion of our industry that really is focused on advice. That would say, my value proposition is the advice that I deliver my clients. It's not the products that I implement. It's not the portfolios that I manage. I may have to do some of that pursuant to my advice, but the folks that would say first and foremost, like my value proposition in the relationship with the client is my advice and the quality of my advice, and that I am here as a service professional to serve clients. And the good news, like you can make very good income as a financial advisor, as we put it, because it requires expertise and experience and hard work. But when we stay really focused on advisors, just the nature of everything from like the content to the research gets a little bit different, right? You don't see on our platform a lot of like 11 ways to get your clients to buy more ABC products. You'll see like the deep dive into the latest tax law or how to hire an associate advisor and ramp them up quickly to better serve your clients and expand your capacity to help serve more people. And I think the second thing that crops up on our platform, just one of our core values as a team is advisors first, which means as I frame it to the team, like our platform can only generate revenue from the advisors that we serve. And so that's why you don't see any advertising on our platform. There's no advertorials. There's no sponsored offerings. There's no like newsletters from our advertisers. There's no revenue shares. There's no affiliate offers. The only way that we get paid is for the value that we're providing to the end advisor that we're trying
Yeah.
to serve. I think of us like the media equivalent of a no commission fee only platform. And it turns out financial advisors appreciate unconflicted education as much as consumers appreciate unconflicted advice.
Yeah, and I think that's actually a very interesting way of putting it. It's authentic, it's smart. People don't feel as though they're being sold when they read it or listen or tune in. And
Correct.
what I find most interesting is that it's not just fee only financial planners that operate as an RIA that tune in.
Oh, no, it's much broader.
Yeah, I've had many wirehouse advisors tell me that they've gotten their best advice. They are your biggest fans. And some of those wirehouse folks wound up leaving the wirehouse world to go independent, and many of them still practice within the world. And even though in the wirehouses they're held to a different standard technically
Correct.
than you are as an RIA, they still see themselves as an advisor. They still see
Correct.
themselves as a
It was very deliberate when I was framing like vision for the team of our platform and who we would serve to create this advisor label that we didn't choose some of the existing words out there in the industry like RIA or fee only because I really do think it's broader. Look, I started my career in an insurance company and this was 25 years ago. The world looked a little different, but I remember that firm very well. There were 22 guys who sold variable universal life insurance and one advisor. There was like one guy who was just different. Everyone there went and just sold variable universal life insurance pitch to any human being that they met on the street. They played the Nick Murray game of numbers. They got enough volume and activity, and some of them were incredibly financially successful. You can make a good living that way. And then there was this one guy who said, yeah, I just bring them in and I give them a comprehensive financial plan, and then I just sell them whatever they actually need at the end. And I just remember thinking when this was like my first introduction to financial planning to say, it just seems easier to like understand what they need and give them that instead of selling whatever it is that was the product of the day. And it very much stuck with me then and still that there are those of us who are advisors across the industry, across the channels. I do think they show up disproportionately in the RIA channel only because when you really are someone that's focused on advice and treats this as a profession of service to others, some of the dynamics and conflicts of product platforms, like working for a company that manufactures or distributes product, which functionally is what insurance companies and broker dealers do from just a legal regulatory perspective. When you're an advisor in a profession to serve, sometimes you start feeling friction when you work for a platform that at the end of the day makes its money on the
Yeah.
manufacturing and
Well,
distribution of product. And I find sometimes that's what pushes people
I was
out
you
to the other
exactly.
channels because you're like, I just want to serve my clients. And the company can only measure me in how much I've sold to them, not like how great I am at giving advice
Yeah.
and how much I'm helping them.
You're absolutely right. We call that friction incongruence. I refer to it this
Mm.
about an advisor who
Yes.
is sitting under a traditional broker-dealer umbrella and begins to feel what you call friction, I call incongruence between the goals of the firm and the goals of the advisor or the goals of the client. That's when and if that advisor may look to make a change. And sometimes it's to break away to
Yep.
independence, and other times it's to go to another firm. And we'll talk more about that in a little bit. But you and I both posted on social media that we'd be having this conversation, and we invited questions from the audience. So I want to start with the top three or four. There were a bunch of them. But the first one is this: is there a widely discussed prediction about the future of our industry that you believe is either overhyped or disagree with?
No, gosh, I'm torn on two. We'll probably get into these over time. I think the number one I will frame just to get the conversation going. I do not think that AI is going to lead to the long-term margin improvement that the whole industry thinks. In fact, in general, I don't think that technology actually creates long-term margin improvement in our industry the way that a lot of people think it does. And I'll back that up in some context. So, as I just mentioned, I started in the industry in a life insurance company. I did not stay there terribly long. It turns out prospecting is not my gift on this earth. I ended out going to an independent broker-dealer, and the firm that I went to at the time was 3 primary producers, about 1.3 million in GDC, which back 20 something years ago, like, that was a very good size shop. And there were about 8 of us that were supporting those advisors. I was in a, like, associate advisor/client slash client service admin role. There were 2 others like me supporting the advisors as well. We had 1 other that was, like, pure back office admin. We had someone on finance. We had someone helping with the marketing. We had a wonderful woman named Betty, whose job was to open all the mail every day, take out all the paper statements, file them in the client's paper folders, make sure there was a check in there because heaven forbid you don't accidentally sit on that for 24 hours overnight. And that was what it took to run that office. And when I look in today's world, a typical advisory firm today with 3 advisors doing 1.3 million of GDC probably could be operating with 2 support staff, maybe 3 if you're investing heavily into marketing, not 8. And when I look at the difference of why did they have 8 and we had 3, the answer basically comes down to technology, right? Like Betty's job to take all the paper statements and check the envelopes for paper checks. That's not a thing anymore. We digitized all that with the internet and mobile and all the amazing technology that's come. But when you look at the underlying industry benchmarking data about how these firms run from a pure profitability end, if you look at the early Moss Adams, Mark Tibergien benchmarking studies, the average independent advisory firm was running with a profit margin back then of 25% plus or minus 5. And if you look at the industry benchmarking studies today, the average independent firm runs with a profit margin of 25% plus or minus 5. So we got all this technology evolution. We got all this like staff savings, yet we don't actually run net anymore, any better margin than we did then. And when you drill down and ask why, the answer you quickly get to is, well, we do a lot more for our clients than we did then, and we do it a lot better. That was still a firm at the end of the day. Like every time a client was going to come in, we'd print out the Morningstar Principia Pro reports for the mutual funds that they held. And if there was one that was particularly not good, we would provide a recommendation for them to change it. Today's environments, like I've got centralized investment team with standardized models that have all of our best ideas fully implemented at once, that's continuously monitored. And like I can tax loss harvest and rebalance that thing down to the day if I want to. Back then, we were lucky to be scrambling to do the trades once every time a client came in for a meeting. Our planning is in more depth. Our service is more responsive. So we do a lot more for our clients, but it doesn't show up as margin expansion, which is how the industry usually talks about technology. It doesn't show up at fee compression, which is the other way that we often talk about technology. Tech's coming and is going to compress all the fees to zero. And instead, okay, median advisory fee on $1 million is 1% now, it was 1% 10 years ago, it was 1% 20 years ago. So the margins don't move. The fees don't actually move. We just continuously take the time savings that we get from the technology improvements to reinvest in our clients, offer them more and better and deeper service and higher quality advice, and keep on marching forward. And so you do have to engage with the technology because otherwise your firm's value proposition falls behind everybody else who saves a bunch of time on the technology and reinvests into their clients instead. But there's all these dialogues. If I just get the right tech, my margins will explode. And if the industry gets the right tech, like all this fee compression's coming. And just as a student of history, when you actually look at how this plays out, it's neither. It never happens that way. We do get efficiencies from tech, and then we reinvest them all into clients because this is a service business.
Yeah, and so I think that's reasonable. And I think that the best advisors and the best firms look at technology, AI included, as a way to make them better. Sure, do they want to be more efficient? Of course, everybody would be to increase productivity. But if the only reason you're investing in technology is to make you more efficient, probably not the most right
We
reason.
You do want the efficiency, but you don't get to go home with the efficiency, right?
That's
You imagine 2
not the only.
advisors.
Yeah.
Number 1 gets this amazing tech and takes Fridays off with great margins. The second one takes this amazing tech and uses the free Fridays to offer a new service to clients or hire a new team member or expand something to do more for their clients. And guess what? When you fast forward 5 years, it turns out the firm that took all the savings and reinvested in a new service for their clients is growing faster than the person who used the tech to get efficiency to take
Yeah.
Friday off.
Yeah. Well, let me ask you an ancillary to that, Michael. In your productivity report, again, which we'll reference in a little bit, you say that advisory firms must be careful not to provide too much service relative to the
Yes.
fees that they charge. So that's probably a good segue, maybe address that.
Yeah, the research that we find around this is just always fascinating to me, and you can see it all over the industry. If you just start asking firms, "What do you charge?" Almost all of us are like 1% on a million, plus or minus a very small margin. And then you say, "What do you do for your clients to earn those fees?" And you see this phenomenally wide range of what advisory firms do, down to a subset of firms that still say at the end of the day, "We manage portfolios well. We put the blinders on. We manage the pot of money. We are really good at it. We've got great investment team and resources about how to do that well and really steward your money effectively." And then other firms that come along that say, "We do the investment management and the financial planning. We'll prepare your tax return. We'll sit in on the meetings with your estate planning attorneys, and we'll help you make sure that you've got the right insurance. And we'll even read through your PNC documents and give you a recommendation if you don't have the right homeowners and auto insurance." And these two firms are charging the same fee, and they're really far apart from each other. Where we find optimal firms is, frankly, somewhere in the middle between those two. I think 1% for a air quotes just investment management only offering is getting harder these days. There's a lot of pressure to say, "And what else do you do on top?" Dot, dot, dot. And there are firms that we still find go way too far into how deep their financial planning actually is. They're usually firms that show up with a value proposition that's something to the effect of, "We provide above average service for a below average fee. We're a good deal. You should want us. We do all these services, and we don't even charge the 1% everybody else does. We charge like 0.9 because we got to be a little cheaper and better than everybody else." And look, from a pure service end, I love the proposition of being above average service and delivering for a below average fee. But most firms that do it don't deliver it with a below average cost. It's not like they found a magic way to do this cheaper than everybody else, because this is a service business. We have to hire advisors to do the work, and talent is expensive. What usually shows up with firms that do an above average service for a below average fee is they do it for a below average margin, and their firm becomes extremely difficult to scale and reinvest into because they just don't have the dollars in free cash flow to reinvest effectively to actually sustain that level of service with an expanding client base over time. And just I would contrast it because if you look at any other industry out there, right, if I'm traveling and I need a place to stay, like I can go to the Holiday Inn, I can go to the Four Seasons. I am very clear about the difference in service that I'm going to get between the Holiday Inn and the Four Seasons. Now, there are times I choose each, like quick road trip with the family, need a place to stay. We're going to hang out at the Holiday Inn. Going on a beautiful vacation and just want to feel like I'm a little pampered and serviced well, like I'm going to get me a room at the Four Seasons. But I'm crystal clear when I do this that when I get a room at the Four Seasons, I don't expect Holiday Inn rates. Like, I am very clear that I am going to pay a premium fee for the fact that I'm getting a premium service. And what we really find as we go through our productivity research is that there are definitely above average advisors, and there's a remarkable dearth of people who charge an above average fee commensurate with the fact that they're an above average advisor. We try to do like Four Seasons service at Holiday Inn prices, and it creates a lot of problems in business models. Instead of saying, as they would at the Four Seasons, although probably nicer than this, yeah, that's how much we cost because we're better than everybody else. And that to me is an interesting gap in our landscape today. Like almost all firms that I see that charge even above 1%, the only reason they do it is because they've got some kind of platform or other fees that come from the firms that they're affiliated with and say, yeah, to be a little bit higher. And I'm able to get clients despite being a little bit higher because I'm good at the service and the advice and what I do. But when I think about just a landscape of service providers, somewhere out there should be a lot more advisors who charge 1.1, 1.2, not because they have to pass through some costs to their platform, because their service offering and quality is that deep and that good, and they really are that awesome at it. And oh, by the way, if they were generating another 10 or 20% of revenue per client, because that's what happens if you go from 1 to 1.1, like you lift up your fees 10%. If their fees and revenue were 10, 20% higher for the clients they serve, suddenly it would be a lot easier to scale this thing up and do it for more people.
Mhm. Yeah, I love that, and I actually think that's incredibly interesting. I'm betting we are going to see more firms doing that over time. I wanna jump to another question from one of our listeners, which was, if you were launching an advisory firm from scratch today, how would you structure it for maximum efficiency and client impact?
So first of all, just I'd go and pick another area where I can become a recognized specialist pretty quickly. One of the lessons that was drilled into me very early on in my career is that it's much easier to become a big fish when you pick a small pond. So you don't need to go fighting against everything else in the big old ocean. Go find a pond that's well stocked and just dip your fishing rod in and catch a lot of fish. So given my background focus these days, frankly, I'd probably end up working with small business owners running companies with 10 to 100 employees because that's what I spend most of my time doing these days across all the different businesses that I've co-founded, most of which are businesses somewhere between 10 and 100 employees each. And that group needs a combination of financial planning for the business owner, tax planning, business consulting advice, and would probably end out with a retainer subscription fee model charging pretty big numbers per client. You get business owners that have millions of dollars of revenue or tens of millions of dollars of revenue and millions of dollars of EBITDA. If you're creating value for them, charging literally tens of thousands of dollars a year in financial planning fees is quite affordable and reasonable to them. Because if I can get in there with a business owner and help you increase the growth rate on your company by 1%, the return in enterprise value and the return to your balance sheet is absolutely enormous, especially if I can then show you how to harvest that additional growth and profitability out in a tax efficient manner and how to channel that through to your personal balance sheet to achieve your financial planning goals at the same time. Because like running business is hard. And I think it's all ironically, I think it's a lot easier today to help a business owner grow 1% faster or be 1% more profitable than it is to add 1% in returns to a portfolio. So there'd probably still be a portfolio management service in there at some point. They get profits out of the business and we have to invest and steward it well. But so few other advisors are really focused in that segment. When I started out, quote, we work with small business owners was code for we try to sell life insurance to small business owners by doing buy sell agreements with them. And I'm not knocking it. Like that's really important as a business owner. I've got insurance for buy sell agreements, or we try to get in there and do their 401k plan. But to me, the untapped value opportunity is help them actually grow their business. And then you can help them figure out what to do with the dollars and value that comes from that business because there's so much value to add there.
Yeah, I love it. And aside from going narrow, being really good and the best in the niche in which you serve, what do you think is the number one thing a firm could do to impact enterprise value, to really build a firm with the end in mind?
If you really want to get into there's sort of short-term answers and long-term answers. I would say the two biggest levers, see, when I really look at like the firms that are chugging along and growing really well and building genuine enterprise value in the long run, and like what are they doing that's making it work so well? The two things I find that most of those firms have solved that very few others have solved. Number one, they have created a marketing engine for the firm that at the least is disconnected from the founder and ideally is disconnected from the advisors themselves. And that's kind of a newer thing in our profession, right? Most of us, if you've been in this business for any period of time, came up in some kind of eat what you kill environment where the whole point is like you go get your clients, and if you can get enough of them, you can have the privilege of serving them and actually being a financial advisor. Otherwise, you're a smart person sitting in front of a phone with no clients. And when you look at almost any other business industry that's out there, people who provide the service don't do the selling, right? Like my doctor doesn't prospect. I schedule an appointment, I go in and I see my doctor. There's someone at the doctor's firm that runs marketing to get the word out about the firm, but the doctor doesn't do marketing and that lets the doctor be way more efficient. In lots of contexts, we have scenarios where I interact with the salespeople, and then once I say yes, I'm going to work with them, I get handed off to the person that's going to service me on an ongoing basis. And that kind of separation of sales from service turns out to be really efficient for advisory firms because especially as we keep moving into these recurring revenue oriented models, we keep paying advisors a percentage of their revenue because we did that in the old days because you got like a percentage of your commissions as you grow. But there's a big difference between getting a percentage of your commissions and getting a percentage of your recurring revenue. When people get a percentage of their recurring revenue, at some point after 5, 7, 10 years, a lot of us wake up and to each their own about their exact numbers, but it's like, I got 50 million or 75 million or 100 million or 200 million that I'm individually responsible for. It might be worth $1 million+ of revenue. I get a percentage of that, 40, 50, 60, whatever it is, depending on what model and your platform is. You're making somewhere between like $300,000 and $600,000, maybe more. And suddenly you get to a point of like, you know what? If I got another new client, it would change my life in zero ways. Like I make good income. I can achieve all the goals that I want. I can do the things that I want to do in life. I will be able to put my kids through college and retire. I'm just not really that jazzed about growing more. Like it's really hard work, and the next new client is not going to materially change my financial picture. And so suddenly a lot of advisors take their foot off the growth gas because they've gotten to the numbers that make it work for them. And that's great as an individual personal decision and a life decision. The challenge for firms that are growing and scaling up is they end out with this huge base of advisors that are getting a percentage of revenue, which is nominally a sales compensation, except they're not actually selling anymore. They're getting it for the people they sold 3, 5, 7, 10 years ago, and not the people that they're selling today because they're not out there trying to sell because they don't really need more new income at this point. And so when you start to separate the sales from service, you can let service people serve, who frankly more often get salaries with bonuses, not percentage of revenue compensations, because you hand them the clients and the clients get handed to them from a dedicated marketing department, which is also a salary plus bonus structure typically, maybe a little bit of commission for your salespeople, but it's very short term and upfront. And what you end out with when you do that over time is people with salary and bonus handing clients off to people with salary and bonus, and your firm's margins start to scale more efficiently than when someone gets a percentage of revenue, and you can never improve the margins of your firm because every time your revenue goes up, all of your staff costs go up perfectly in line because that's what happens when you're a percentage of revenue, and you get challenges. So on the one hand, firms that build a marketing engine that can separate sales from service for their advisors, we see just very different dynamics around their growth and sustainability, and having a healthy organic growth rate is just a monster impact to enterprise value. Because anybody who's looking to buying you is going to say, show me your organic growth rate for the past 3 to 5 years, strip out the acquisition, strip out market. Like, let's see what it's really real. Strip out net note flows from existing so we can actually see client organic growth. And those numbers aren't very high for most of us. And so if you can build an actual marketing engine for the firm, the numbers lift up a lot. The second thing I'd add really quickly in that vein then of like the other dimension that we see for firms that are doing well on enterprise value is, and they have some kind of talent development system to keep filling the seats on the bus as they do this. Because if you do a good job building a marketing engine that makes the proverbial phone ring and fills advisors so that you can just assign clients to advisors, you need advisors, and they have to be good because you're spending all this money on marketing and bringing clients in. You want to make sure that they're served well. but you actually need them to be able to take clients, which means the old-fashioned way that most of us recruit advisors, which is you find people that have a good book that can come into your firm, that actually doesn't work when you're scaling a practice that has a genuine organic growth marketing engine attached to it. You need people who don't have clients. And it turns out finding good advisors who don't have clients is hard because if they're that good, they usually have clients. So sometimes you can peel them away from a firm that has some kind of non-compete, a non-solicit that prevents them from bringing existing clients. And so you can attract them on board. But more often I see of the firms that do this well, if you get good at solving the marketing engine part, then you have to build a talent development system so that you can actually grow talent internally to get them to the point that they can do the advice services that you need. And when you get both of those firing, we have a healthy organic growth system that's not dependent on our advisors and a healthy talent development system to bring up the next advisors so that I know who's going to be serving those clients in 5 to 7 years by the time that advisor moves up. That is an enormously valuable enterprise from a business enterprise perspective. And very few of us are solving both of those problems.
Can you give us an example of a firm or two that's nailed down on both fronts?
Well, there's a few firms I know that frankly are very happy about the fact that they're flying below the radar screen, and other folks don't even realize that they're out there doing this. I was hanging out with a firm actually at the Future Proof conference down in Florida last week who's doing this. They have an incredibly heavy content marketing machine that's chugging along. They're about $3.3 billion under management, 45 or so team members. 100% organic. They were 1 billion about 4 or 5 years ago. They're growing at a 40% CAGR, all organic, because they built a really good sustaining marketing system run by like a 3 or 4 person marketing team. And they're building out the talent development system because their biggest problem is we can't find advisors who can come in and take 100 clients in the next 3 to 6 months because that's how fast we're bringing them on. When I look at larger firms that are doing versions of this, firms like Creative Planning, Peter Maluk's firm, have done a lot of this. They've gone more inorganic acquisitions over the past 5 years. So they get a little bit more headlines on the M&A side. But the first 15 years of that firm was building out their organic growth systems and building out their talent development systems. And notably, Creative Planning got one of the highest enterprise values that anyone's seen in the industry a few years ago because the whole firm is a W-2 salary and bonus style system. They got some variable comp in there, but like their whole system is built around that mechanism. They have heavily separated field sales from service. They have a heavy marketing engine presence of a lot of different ways that they drive growth, and they got a tremendous premium in the marketplace for it.
Let's look at your most recent white paper, the research study about what drives productivity. So give us the headline. In your opinion, what everybody wants to know, what are the key drivers of productivity? And what are the things that the most productive and successful advisors are doing
Sure.
differently than their less productive peers?
So to start with, I guess a little bit of the punchline up front per some of my earlier comments, the thing we're not seeing driving productivity, particularly for advisors specifically, as opposed to like the firm in the aggregate, the thing that's not showing up in our numbers is technology. So when we talk about productivity of advisors, we primarily talk about revenue productivity, right? So simplest metric, take the total revenue of your firm, divide it by how many advisors there are who have client management responsibilities in the first place, and you'll get to a revenue productivity number, a revenue per advisor. That's like the primary number that we look at for these metrics, right? At the end of the day, how much revenue does an individual advisor responsible for clients able to manage and sustain in the firm? And then behind that, we build team infrastructure and support in place. And we might use technology to make the back office more efficient and such. But like what drives revenue productivity of advisors? Now, revenue productivity gets a really wide range of what firms are able to do in the first place. If you look just like very broad industry wide, revenue productivity out there can get anywhere from at the low end about $200,000 to $300,000 just once you're at least established enough to be running on your own in the first place, right? So think like a quote unquote smaller rep in an independent broker dealer that's like, I've got my 200 clients that I managed to cobble together over the first 4 or 5 years. It's a lot of volume. They're not big dollars, but it manages to add up to $250,000 of gross production. And I'm entirely solo on my own. At the other end, you get like large teams at wirehouses and the like, where assets aside, we get down to revenue. It's like, okay, we're a 2+ million revenue team. I'm like, okay, but how many advisors are on that team? It's like, well, there's really like 3 of us serving together in a team. So we'd say, cool, like 2.4 million of revenue, 3 advisors on the team doing this. Your revenue per advisor on that service team is about $800,000 of revenue per advisor. So those are the sort of metrics that we look at and think about. So when we get down to that domain, it turns out tech doesn't show up very much for what drives productivity, for the remarkably simple reason that most things as an advisor that would save us time with tech are things that we should have already delegated to team. Like, I can save a lot of time with better tech for my onboarding process. Or you could hire an administrative assistant who does your onboarding process, and then you don't spend any time on the onboarding anyways. Now, tech matters for my team, right? As I start scaling up, if I can hire 4 admin support instead of 5 admin support for my billion-dollar firm because I'm getting more tech efficiencies, yay, I saved 1 person on headcount. But most of the tech really shows up as back office efficiencies. It makes our administrative and support teams more efficient. The biggest thing that we find actually that makes advisors more efficient, the number one driver, is just having a team. When we look at the income ranges of advisors, from the most productive advisors to the least productive advisors, even when we look at the most productive solo advisors, like pure solo, no support team around them, top out at an income that's about a third of what advisors that have teams are able to build. And almost across the spectrum, advisors who are pure solos earn about half of what advisors do at the same income percentile when they have some kind of team structure around them. We search for tech when we should just hire someone and delegate to them, and maybe let them figure out some tech things to make their lives more efficient so that at least it'll be longer before I have to hire the next person beyond them. But having any team, even just once we add a client service admin, produces a much more material lift than anything else that we can find. It skyrockets our face time with clients. It skyrockets our time to be serving clients more directly and doing all the things that ultimately deliver value for them, which gets us fees and revenue and allows us to attract better clients that will compensate us better for our services. So having some team in place, someone to delegate to, becomes truly like the number one driving factor.
But it's hard to find team members, and I think you'll agree with that. So let me ask you a question. You've got an advisor who has a team, a small team of support staff, et cetera, and looking to do things to both grow exponentially, to take the business up market, meaning to
Yep.
go after more high net worth clients. How do they go about what should they be culling clients? Should they be better training their existing team? Like, what else can they do? And presuming they're smart enough to continue to be looking to add talent, but what are the other things they can do to impact growth, efficiency, and taking the business upstream?
There's 2 things that start to crop up if we're gonna do this and move up market. And I will note, like, when we go through the different things that make advisors productive, there's 4 core things that we found. One is, like, having a team so you can increase kind of face time and client activity. Number 2 is having the right team structure. I'm gonna touch on that in a few minutes, right? Like, basically, there's a Goldilocks thing. Team can't be too small or too big. Something in the middle ends up being more productive. The third is pricing. Getting back to the earlier Four Seasons holiday and analogy, it's really hard to be productive when you do awesome things and just don't charge what it's actually worth in the marketplace. Like, you just literally get less revenue because you're not charging the fair market value for your services. And the fourth is serving more affluent clientele. The One of the biggest differences between the least productive advisors and the most productive advisors, just full stop, the most productive advisors have more affluent clients who have more dollars and write bigger checks. It really is that simple and straightforward because, look, people that have more affluence, I'll just use that word generically, folks who have more affluence tend to have more complexity. Not always, but more frequently they do, and they have much more financial capability to pay for it. So if you look like in the legal realm, there are $300 an hour lawyers and there are $1,000 an hour lawyers. And when you say who hires a $1,000 an hour lawyer, the answer is a subset of people who have a lot of complexity and a lot of financial capability to pay a good lawyer to solve that problem. Similar thing crops up in the advisor world. The more you've got services that effectively serve and support upmarket, the more you get paid for your time. Most of us don't charge per time, like hourly is not a very popular model, but it still comes down to the same thing. We all have the same number of working hours in the year, plus or minus a little. And so if I take my gross revenue and I divide by my working hours, I can get back to the same kind of equivalent. Am I making $300 an hour, $500 an hour, $700 an hour with my time? If I want to be serving clients who will pay me the equivalent of $1,000 an hour for my time, it turns out that I need to work with higher dollar clients in order to do it.
And what about the services, the additional high touch services, concierge
So,
services, a big word that you would
yep.
need to add or that ultra high net worth clients expect?
So getting your earlier question and comment then, yeah, one of the big drivers, high dollar clients, not surprisingly, take more time to serve than lower dollar clients, right? All that complexity, all that stuff that they want means that they take more time. Now, the good news is they do typically pay for that time because they've got more financial wherewithal, right? Even with a smaller breakpoint, applying my fee schedule to someone with 5 million, 10 million, 20 million, $50 million pays me a lot more for my time than trying to add it up, charging 1% fees for millionaires or charging 1.1 or 1.2 for a big gaggle of clients with $500,000. So the $50 million client takes a lot more time than the $500,000 client, but not 100x the time, which is why we effectively get compensated much more for our time and end out being more revenue productive when we're working with them. But because they take more time, one of the fundamental constraints is that if I'm going to move up market, particularly if I'm an existing advisor coming from the place that I am now with all the clients I've gotten up until this point of where I am today, if I'm an existing advisor who's planning to move up market, I can essentially guarantee you it will be impossible for you to move up market without shedding some clients because you cannot spend, unless you're sitting around today with a bunch of spare time that you're not using, it will be impossible for you to put in more time per client with the clients that you've got because you're already using all the time you got on the clients that you've got. You're only getting there by shedding clients. Now, shedding is a harsh word for it. And there's lots of different ways that we can go about it. We can hand off the clients to another advisor in the branch or within the firm. We can do a partial book sale if you're in a firm that allows that. We can send them into the home office and participate financially. We can just quote unquote graduate the clients and say, look, we've had a great journey. I don't think our services are the best fit anymore. We're going to really be predominantly serving clients with at least $10 million of assets with a minimum fee of $50,000 a year. $50,000 a year fee is probably going to be a little bit high for you given your $750,000 portfolio. So I recognize that we're really not a great fit for you at this point. Here are 3 other advisors that you can work with that would take great care of you. But you have to be prepared for the fact that you're going to need your book to be smaller if you're going to spend meaningfully more time with each client to show up with the value and depth that you need to for more affluent clients. Now, you don't necessarily have to do that in one fell swoop. Some folks do. They really might do like a partial book sale or something similar and just carve off a segment of clients at once. Failing anything else, I like just simpler gradual systems like, okay, from now on, every time you add a client that's in your sweet spot, you need to remove 2 clients that are not, right? And if you do 1 on, 2 off, or heck, if your new clients are big enough compared to where some of your legacy clients are, you could even do something like 1 on, 3 off. Every time I get a new client on, I move 3 off. You know what? If I'm adding $10 million clients and I'm subtracting under $1 million clients, my business even still grows. Like, it's not like I have to go backwards on my revenue or anything else by doing that. I just slow the growth a little bit because I'm subtracting some of my smallest clients as I'm adding bigger ones. But that's how you create the capacity to be able to serve a larger base of bigger clients so that eventually you go from I had 150 to 250 of clients that I built the business with, and you eventually winnow down to I've got 40 multimillionaire clients that I'm super deep with and spending 30 plus hours a year with across multiple meetings and lots of behind the scenes work and actually having the time to be the financial quarterback, not just saying I'm the financial quarterback, but
Mm.
literally showing up at the estate planning meetings and having 3 hours of calls with the CPA back and forth to plan out a cool strategy on behalf of the client because I have the capacity to do it because I only have 40 of these super high quality clients. And if I've got 40 of these clients and they're paying 50 plus $1,000 each, guess what? You're like a 2 million revenue producer with 40 high quality clients that you finally cleared the space for.
But that speaks to capacity, and I get that totally. I think that's sage advice. But are there additional services, niche services, concierge services, access to private investments, whatever it may be, that a firm or an advisor would need to add? So, and I'll tell you why I asked that question. Because if you talk to an advisor that
Well,
works for a
so
traditional big brokerage firm, one of the things they'll tell you is they're afraid to go independent because ultra high net worth clients want access to a lot of the fancy services that the big firms offer. So, how does an independent RIA that's now taking the business upstream, what other services do they have to add in order to compete in that market?
So I'll try to answer that two ways. It depends a little bit on the segment that you serve because look, there's a self-selection bias, right? When I work for a big firm that sells like the depth of our banking and lending desk areas and the fact that we can do securities-based lending at a really favorable rate, we tend to attract clients who are really interested in securities-based lending at a favorable rate. It turns out there are a lot of other high net worth clients out there who care about different things than that. That's not the hot button for everyone. That's the hot button for a particular segment. That being said, almost everything that exists in the wirehouse environment is getting recreated on the independent channels anyways. Like securities-based lending capabilities are out there. Platforms like Case are just building out monstrous alts distribution platforms for almost anything under the sun. Not everything, because some platforms will still have access to certain deals that others won't. But alts are getting expanded. Independent trust companies that will work with advisors to offer the trust support and the trust administration services are getting built out. A lot of those capabilities are getting replicated on the independent side. But even more directly, like, look, at the end of the day, your clients pick you for you, or at least ideally your clients pick you for you. If your clients picked you because of the name at the top of your business card, then frankly, maybe you don't want to go independent. You want to stay at the firm that has the resources at the top of the business card. But when clients are picking you for your services, they want you and they want your advice and your expertise and your presence and your knowledge and your understanding of their situation and the relationship that they've got. And when you go to them and say, hey, going forward, your securities based lending isn't going to happen from ABC Wirehouse, it's going to happen through Schwab. It turns out it's pretty fine. And when you say, well, I found a new trust company to do the trust work that we do, here they are and they're great. And there's a couple of players in that space, then off we go as well. So when you really start talking like what are the services to me that actually start to differentiate, you get into things like, well, how deep are you with the attorneys? How deep are you with the accountants that specialize in their situation? How deep are you into their businesses and business consulting? How deep are you into their complex life insurance needs? But how much are you adding additional concierge services because you're helping the family beyond that to figure out how to finance the jet properly? And all of those services already get done in the independent channel. They have for a long time. Family offices were out there and the multifamily offices were out there. And then the RIA channel started moving into that space as well and is growing by serving the same clients in the same way. And as it turns out, a lot of them actually like it when we're quote unquote just the service provider because they know what that means is if you ever found a bank relationship or a lending relationship or an insurance relationship or an alts relationship that's better than the one that you've currently got, you're going to cut it immediately and go to the new one. And when we work for a big firm, we literally can't do that. Like we are legally obligated as a representative of the firm to use only the stuff that's on their platform. And so hopefully we're with a firm that's a good platform and offers a good suite of services and support capabilities to us. But a lot of high net worth clients actually really like it when we're independent and we can pick anything that's good for them because we don't really care what the platform is. We just want to make sure the client is well served.
Yeah, I appreciate that answer. I think that's very fair. Let's pivot. You mentioned before about ideal team structure, and I think a lot of people would be interested in hearing your take on that. What does it look like?
So I have to know relative to our discussion here around client affluence, our sort of general answer will look a little bit different for higher net worth clients. So I'll come back to it in a moment. The baseline that we find for what are optimal team structures, aside from just having a team in place, is having a team that is not too big. We see a lot of team structures out there that start getting really big, and we get like 4, 5, 6, 7 people on the team with all these different specialized roles and multiple advisors. And what we find is that as teams get larger, their productivity actually starts to drop quite materially. When we just look at something very simple like revenue per advisor, revenue per team member, right? Just at the end of the day, how much revenue are we bringing in for the amount of people it takes to service this revenue? The optimal team structure comes out to be what we call a 1+2 structure, which is simply one lead advisor and two support team. That's typically one associate advisor who can at least handle the more basic financial planning questions, is going to be in all the meetings to help capture the notes and the takeaways and the action items and draft the recaps and follow-ups and such, and a more administrative operations support person as well. And that three-person team, you think of it like a triangle with the lead advisor at the top and support people giving a base to make that really stable, ends out being remarkably optimal from a revenue productivity perspective. What we find when teams get bigger, it does help to have a bigger team in that there's more people to delegate to and more tasks that can be handed off. The problem is, as the lead advisor at the top of that growing team, you're typically the one that has to manage them. And what we save in delegation time, we end up taking back in management time, which means I don't really end out being able to handle a lot more revenue with a much larger team. I just end out spending a little bit less time on some tasks I wanted to delegate and a little bit more time doing one-on-ones and hiring and performance reviews and all the other things that go with running that team that reports up to me. The secondary challenge that we see with these teams is as they start to expand is when we get multiple lead advisors on the team, we start splitting and sharing clients, right? A lot of this do this sort of naturally. I'm going to add an advisor to the team. I'm going to carve off the lower segment of my book. I'm going to hand it off to them. They're going to primarily manage that client base so I can focus on my A clients. It's like, yes, but a lot of the time we still end out in a handful of those meetings. Not all of them, but a number of them because the client still pulls us back in from time to time. And when you start sharing clients on the team, the mathematical reality is revenue productivity starts going down, right? If I keep putting two advisors in the room, generally speaking, most of us don't charge double the fee when two advisors are in the room. So if we put two advisors in the room to service the same revenue that we were going to get, even if only one advisor was in the room, it turns out we just have half the revenue productivity and we fill up our capacity twice as fast. So there is a point where we're working with very high dollar clients who really do actually pay us enough to put more than one advisor in the room. And when we do that, we start seeing a lot of teams show up with 3+2 structures. So 5-person teams, three more senior advisors who have client relationships. Usually it's like one super senior at the top who gets pulled into two core service advisors that support them that are primaries on those relationships, but can pull the senior person in, and then two support team, like an associate and an admin, or maybe two admin that leverage those three lead advisors. They're still not as revenue productive as the others, but they at least start lifting up if we're working with very high dollar clients where we really do actually get enough revenue per client that it pays to have multiple advisors in the room, and their situations are complex enough that it makes sense to have multiple advisors in the room. But many teams, I would even venture to say most teams that we find, it's a version of what we said earlier, like we're trying to grow and move up market. We hit a capacity wall. And rather than just say maybe these clients aren't a good fit anymore and figure out how to transition them away to add more clients, we keep the clients on our team and we add advisors to the team. And we end out dragging down our own productivity because what I'm saving in time and delegating those clients, I have to take back in time to manage the advisor on the team who's serving the clients. And by definition, they're my lowest revenue clients, which means my advisor takes up a disproportionate amount of the revenue. So my advisor actually ends out with a book of clients that's not actually very profitable to the firm. And so I end out with an unprofitable advisor working with unprofitable clients for which I don't free up much time because I have to manage them. And I'm still in the occasional meeting that I get pulled back into. And when I did all of this because I was trying to expand my capacity, the answer is I don't actually end up expanding my capacity very much, which means I can't move up market to working with more affluent clients. And the team just ends out getting its productivity dragged down by having too many people on the team at the same time. And so teams that stay leaner and focused, we find tend to have much better revenue productivity. And the sweet spot, at least for most of us, is a 1+2 team. But again, when we look at working with very high dollar clients, the teams do start to show up a little bit larger than that.
Mhm. The word balance comes to mind in almost everything we're talking about. That so some may say, "Oh, well, then let's just have a team of 50 people and just keep adding." But there is a point where the balance gets tipped and too much is too much because you're managing more than you're producing. And so it's always about finding the right balance. I want to pivot for a second. We just published our annual advisor transition report,
Yeah.
and we started writing it because the published stat every year is that every year about 5 to 6% of all
Sure.
advisors change firms. And advisors wanted to understand why advisors are changing. What's the story behind those numbers? Why are they moving? What are they getting paid? What are the drivers? Where are they going? What are the things that they were worried about? And those are all the things we talk about, not only the stats and where they're going, et cetera, but the why behind it. I want to check out a couple of things with you.
Sure.
We talk a lot with advisors that, in our view, and we mentioned it before, that a big part of the reason advisors make a move, whether it be a lot of times leaving a big firm for a smaller one, leaving any firm to break away and go independent, going from one big firm to another, is because they feel a sense of incongruence, friction,
Yep.
as you put it. So, talk to me a little bit about that. Do you agree with that? Do you see it as I see it? That's probably the number one reason for a move. And if so, why? And if not, what do you think?
So, yes, I certainly see it. As to whether it's the number one driver for a move, I guess it depends a little bit on where you're moving because I think about movements within channel, which as we know is actually like the majority of them. Movements within channel show up a little bit differently than movements out of channel, right? The motivators to go from wirehouse A to wirehouse B or IBD A to IBD B is a little bit different than like what makes me break out of the brokerage channel to go to RA and cross a channel barrier. I would say like we certainly see incongruence as a major driver, but I would almost segment it to me that there's 2 different versions of incongruence and how it shows up. I think alignment is a good word for both of these. It's still the same principle, but it shows up in 2 different ways. The first, kind of getting all the way back to our discussion at the beginning about advisors, is when I'm trying to build a business where my value proposition is my advice and I'm here to serve. And yes, clients have dollars and they need to land somewhere. So at some point, like I'm going to allocate portfolios and the like. But when I'm primarily here to share expertise and serve my clients, and at the end of the day, I work for a platform whose business model is to manufacture and distribute products, I start feeling some of that friction and, as I frame it, incongruence, as you frame it, lack of alignment in the simplest sense, right? And it shows up in all sorts of ways, right? It's like, hey, that's great that you got the planning fees, but you start feeling the pressure of, but how much did you gather in assets? Or that's great that your asset base is growing, but you didn't do enough production and company product. And so thanks to our new integrated grid system, we're actually going to cut your payouts on the investment and planning side because you didn't do enough company product. Right? It starts showing up because, look, the companies all want to support us as advisors, but at the end of the day, if you're a manufacturing distribution company, you make your money on the product you manufacture and distribute, not all the other things we do as advisors. That might be wonderful service for clients that we as advisors get compensated for, but the companies don't, right? If you just to like grossly oversimplify into a couple of buckets. There's the money that companies make on their own proprietary product. There's money that companies make by taking a slice of the sale of third-party products, right? Rev shares and the like. And there's the money that companies make by just getting, call like a percentage of our grid or our revenue directly. We as advisors are most focused on the third bucket, right? How much of the grid do I get? Do you get versus what do I get? Because that's what impacts my pocketbook personally. From a company perspective, the overwhelming majority of their revenue and especially their margin, sometimes literally 100% of their margin on the platform, is made in the first two buckets, primarily the first if you manufacture your own product. And so we just get these misalignments where the company's like, yeah, we can haggle back and forth about another point or two on the grid, but the truth is we make 100% of our profits on the proprietary product that you sell. And so I'm going to adjust your grid based on whether you're doing the thing that actually makes us the money. And we feel that incongruence when we're trying to serve clients sometimes, and that creates the friction that says, peace out, I'm out of here. The second version of incongruence I find that shows up is just, I'll call it like alignment of resources. Most of us in the BD world, like we get our payout and then we use that to run our P&L as an advisory firm. If I'm in the wire world, I don't necessarily have a lot of other expenses downstream from that, aside from maybe some of my biz dev expenses. If I'm at an IBD, I've got a lot of like internal team and staffing and rent and office expenses to do, because that's the whole point of like, if I get an 80 something payout instead of a 50 something payout, that 30% difference is because I'm covering my own overhead now and I have to staff all the overhead back office side of it. And so platforms provide us a suite of capabilities in exchange for the revenue that they keep. IBDs do a smaller set of services for a smaller percentage of revenue. Wirehouse and the like do a bigger set of services for a bigger set of revenue. So a lot of us are quite happy with that deal and what we get, which is why I always look at the flip side of your numbers, Mindy, which is, yes, like 5 or 6% of advisors changed firms last year. That also means like 95% of us stayed put. So most of us are actually reasonably happy with the services that we're providing in exchange for the cut of revenue that the platform is taking. But when those don't line up, then the friction starts to
Mhm.
happen. I see this get expressed lots of ways. My platform takes a pretty high percentage of revenue, but I still have to hire a bunch of people on my team, which essentially to me then comes down to, well, then apparently they're using the money that they're collecting from you on other things that you must not be using, because you still have to hire your own team to solve the rest of the problems that the company isn't solving for you. Or I just hear my company offers a lot, but I don't really use a lot of their stuff at the end of the day because I've built my business in a particular direction. That means I just don't need as many of the things that are available on their platform. And at that case, like I'm paying for a bunch of stuff that I'm not really using. That's an incongruence misalignment, and off I go. Or it just comes down to my platform provides me a bunch of services, but I think in the independent channel, I could just find my own independent partners that do the same things less expensive for my clients or less expensive for me. So it's a version of I'm overpaying, or I feel I'm
Yeah.
overpaying for the platform of services that I'm getting.
I actually agree with you 100%. I think lack of alignment is a good word. I think a lot of times it comes down to I feel like I'm overpaying. If I work at a traditional brokerage firm and I'm paid on commission, I feel annoyed that the firm is taking more than 50 cents on every dollar, and I don't believe they're giving me more than 50 cents on
Yep.
every dollar worth of value in return. If they work for an independent broker dealer or they're paying a service provider, they need to be sure that the value add that they're getting is in alignment with what they expect to be getting and what they feel that they need. And then
Correct.
the other lack of alignment, as you put it, comes down to, do we see the world the same way?
Yep.
Does the fact that they're incenting me for X and I believe that my clients need Y, when that
Yep.
disconnect or that misalignment, that friction, that incongruence, all the same thing gets great enough, that's exactly when people move. And I see it the same way you do. If 5 to 6% of the population moves every year, it means 94 to 95% of advisors are
We're hanging out.
happy enough where they are. I
Mhm.
wouldn't necessarily say happy because there
It's
is
fair.
no
Yep.
perfection.
But there's some friction to moving. So like you got to get to a certain
There's a
level of
lot of
unhappy before you're willing to
moving.
take the leap.
You bet. And in fact, we tell people you shouldn't move unless you find something That's more than better enough. Like, it can't be good enough. It can't be just better in some areas, but not necessarily needle moving enough. Moving is a hassle. It's
Yep.
disruptive to clients, it's disruptive to momentum, and you wouldn't and shouldn't do it unless the value add upside for the right reasons are there. All right, let me pivot now to the future of what you think client needs will be. I read somewhere you said that as financial firms increasingly narrow their offerings to focus on core areas like retirement planning, investment management, tax planning, and scale back on insurance and certain client spending areas, what does that trend reveal about the future direction of financial planning services and the needs of clients?
So I look at this the way by mapping out to how a lot of other professions have evolved. In medicine, we have generalists and we have specialists. You need a little bit of each, right? Someone's got to be the family practitioner, but the generalists make less than the specialists, like quite consistently. Family practitioners still make a pretty good income by US living standards, but the neurosurgeon or the cardiothoracic surgeon makes like 2 to 3x what the family practitioner does. And that phenomenon shows up in most recognized professions, right? The corporate M&A specialist makes a lot more than the generalist attorney in the middle of town who can fix your parking tickets and do the real estate deeds and write that quick will for you and the miscellaneous things that a general practitioner can do. And the same in the accounting world as well, right? The forensic auditor that can go deep into detecting fraud on the books gets paid a lot better than the generalist accountant who just keeps the books of the business and does some CFO projections. So specialization trumps generalization in really any profession. And it doesn't mean that all of us become specialists. Some of us stay generalist. Sometimes it's because we don't know what we would specialize in. Sometimes it's because maybe we just don't quite have the horsepower to get to that level of specialized depth and capability. Sometimes we just like the kind of general relationships and the way it shows up and the way we interact with the world. And if we make enough money, then it's cool for us. So yay. But when you look at growth oriented folks in any of those professions, it's really clear that the path is towards specialization. And I think you're seeing the same thing emerging in our space as well. We don't have as many specialists today. We're still mostly generalists and work with anyone who can work with us who meets the financial minimums to work with us by asset minimum or fee minimum or whatever it is. But the paths to productivity, the paths to higher income, the paths to more successful businesses come from specialization in basically every other profession that's out there. And I see absolutely nothing to say our business is going to evolve any differently. We're a little newer and earlier. Financial planning's been around for 50-ish years. It's only really been getting deep for the past 20 or 30 years. Medicine and law and such have like a century or a few head start on us, so they've gotten further down this road. But ultimately, I see us continuing to move towards specialization, and particularly in our industry where there are some just very large, high volume national firms that are going to do the generalist thing, right? So if you want to be a generalist at some point, it's going to get really hard to compete against Schwab and Fidelity and Vanguard and Merrill Edge and the platforms like that that are just aiming to serve a very wide swath of the market with some core offering. Like, I'm not even trying to be negative to those offerings, but if you want to be a generalist that works with anyone in town to do whatever it is that's going on that happens to have X dollars, and you're competing with companies that have large national reach and national budget to advertise their services as well, with all the trust that comes from having their name at the top of the business card, this gets really hard. But when you start to specialize, none of those companies come after you, because if you build a wonderfully, ludicrously, amazingly successful business that brings in billions or tens of billions of dollars of assets, you are still less than 1% of a wirehouse's asset base, which means you could build a firm of tens of billions of assets and you would be too small for them to ever think about coming to compete with. And that to me becomes the opportunity. And just it's again, it's how a lot of professions evolve from generalist to specialist, and it's how a lot of industries evolve when you've got mega players and much smaller players at the same time. The mega platforms become the generalist for everyone, and the small players compete by creating specializations that each nip away at the larger platforms. Because I'm the best firm for United airline pilots hubbing through Newark because I'm based in Newark. I know another firm that's an expert in American Airlines pilots because they're down in Dallas where the hub is down there. Maybe I go after employees at a particular tech company. Maybe I go super deep into business owners who've had an 8 or 9 figure exit and are trying to figure out what comes next in their life after a big liquidity event and want to get really good at philanthropy. You can go wherever you want, up, down, and sideways in the landscape when most of us at the individual advisor level can have wildly successful businesses with like 50 great clients. So if you want to have a 10 advisor firm, you need 500 great clients. Like there's almost no limit to how small your specializations can get because there are hundreds of millions of people in this country. And if you can be wildly successful with a couple dozen great clients for you or a couple hundred great clients for your whole multi-advisor, multi-billion dollar team, you can get really focused and still have more than ample space to be wildly successful.
But there are advisors, really successful advisors that specialize, that have really tight niche practices sitting at big brokerage firms and banks. Private bankers would be an example. We work with many advisors that have 40 or 50 clients tops in a tight niche specialization and do incredibly well. And they look down on the folks that are independent because they don't believe that their ultra high net worth clients in whatever specialty they were would not be able to get the same level of service, attention, needs met, technology, whatever it is, fill in the blank that they could at XYZ firm. What would you say to them?
Or just they do. Those services and capabilities are out there on the independent channel. It was sparser 20 years ago, but really not all those capabilities were out there. But it turns out that the US economic system is relatively efficient. And when some enterprising firms started realizing that there are bajillionaire clients in the RIA channel, all this stuff started getting built for the RIAs. And the RIAs say to the industry has these capabilities as well for pretty much anything that I've seen out there. Or at least there's some variability from firm to firm in the same way that even in the wirehouse world, there's some variability from wirehouse A to wirehouse B, not naming any names in particular. The capabilities have been built because it turns out capitalism is pretty good at allocating resources to needs. And so as consumers started choosing the RIA channel, just look at the industry meta level data from folks like Cerulli, the wirehouses have been losing market share to the RA channel basically every year for 20 years. Not massively, it's like 1 percentage point a year, but 1 percentage point a year for 20 years is a 20% relative move, which is why now they're projecting, I think in the next couple of years, the RA channel passes the wirehouse channel. And so, look, like consumers are already voting with their feet that they're finding the solutions from the advisors providing them on the
Mhm.
independent side. Like they are out there. It works a little bit different because when you're an independent, you put together that offering for your client by finding the providers that you want to use in your business to help serve your clients. So some of us just don't necessarily want to bring and put all of that together, which is why 95% of us stay in the channel place that we're in because we like the platform that's been brought before us. But just the support capabilities are out there now. Like the channels are reaching parity, and again, the even more fundamental underlying piece I would highlight is in general, your clients don't pick you because of the capabilities that your platform provides. They picked you for you, if only
Mhm.
because they could have picked like 9,000 other advisors at your
Right.
platform if they just wanted access to the platform. They pick you for you. And if you can help them solve those needs elsewhere, then you're still able to serve them. And heck, I know one advisor who went independent and for some of the like really specialized lending needs that their clients still have, he actually refers the client back to the former branch he left. Only to do that, he's like, I have the rest of the relationship and thou shalt not cross over and
Mhm.
poach my client. But he has such a good relationship back to his old colleagues. He's like, fine, you guys can still do that. But I do the other 99% of what the client does, and the fact that I'm the one that solved it for them, including bringing them back to my old colleagues, means I'm still their advisor and I'm still winning that business.
Yeah. I don't disagree with you at all, and I think it's a good way to wrap this up because the reality is Baskin Robbins makes 31 flavors of ice cream because different strokes for different folks.
Yep.
And your point, is that if someone has entrepreneurial DNA, feels a misalignment, incongruence, friction, whatever you want to call it, in the brokerage firm with which they work, and they want to go independent, they have the desire to be independent, all of the capabilities, all of the technology, all of the solutions, all of the support exist. And so an advisor is free to practice as an independent, free to practice within a brokerage firm. It's why I think that to be an advisor today is the very best profession. It's
Yeah.
exciting and interesting because the industry landscape has expanded so exponentially. It's much more likely for an advisor to find the exact right home for themselves. They should never feel stuck or have to
Mhm.
settle. And B, the values for advisory firms and advisory businesses, advisors that are built the right way for the right reasons, the values are sky high at high water
Yep.
marks.
Sure.
And that's what makes it so exciting to be an advisor
Well
today.
and I mean, getting to just your overall theme, Mindy, around an incongruence, just calling a spade for what it is. There's a lot of platforms out there that tell their advisors, "You can't get this anywhere else. We're the only ones that provide it," because they don't want you to look over the mountain and see that the grass might actually be greener on the other side. They're just saying the line that the thing is something that only they provide, and it's just really not actually that
Mhm.
unique. It is provided out there elsewhere. Other people's have the capabilities as well. Again, the economy and capitalism is actually pretty efficient. If there were really that many high net worth clients that absolutely insisted on the service and it was only provided by one major firm out there in the landscape, like, do we really think no one else would build a similar capability when there's demonstrated demand from high net worth clients for it? Just resources go to fill the need. Capitalism's good at solving these problems, and it has. So just yes, individual platforms will have slight differences, but just capability parity has really largely been built over the past 10 to 20 years because people are willing to pay for it. And so vendors showed up to say, then we'll serve it and do this for the independents the same way that retailers did it themselves.
So what it comes down to is advisors get to choose how they want to live their best business life. And so I am incredibly grateful for your time today. We've already gone almost an hour and a half and we could go longer. So I'm grateful for the insights. I hope you'll come back again. Just to wrap up, what is the next research report coming out and what else can we look forward to from you?
So I guess apropos for the discussion, the study that we're fielding right now is around advisor technology. So all the different technologies that advisors use, primarily on the independent channel, what's popular, and more important to me, like, what do they actually like? Which ones are good? So we call it our advisor technology study. It parallels the advisor technology map that we put out, which, again, apropos to the discussion around capabilities, 6 or 7 years ago when we started mapping the technology in the independent channel, there were like 150 to 200 different vendors across about 20 something different categories. Now there are over 500 vendors across about 38 different categories because there's been such a proliferation of technology and capabilities over the past 5 years. And frankly, all the VCPE money flowing into the space is just amplifying it further because capital follows opportunities in our system. So we'll be putting out our advisor technology study sometime in the summer, probably around July. Again, 500 plus vendors, 38 categories, and what advisors think of each and every vendor that we can get any level of feedback on to show folks what's good and what's useful. So a lot of independents use the map and the research, figuring out if they should be switching technology, and a lot of folks who are launching and going independent use the map and the research to figure out how to pick their tech stack in the first place.
Great. Well, we will look forward to seeing it. Michael, thank you again for your time, your wisdom, your generosity, and all you do for the industry.
My pleasure. Thank you, Mindy.
You bet. As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.